President Trump and his fellow Republicans are forging ahead with the most sweeping overhaul of the nation's tax code in 30 years. Experts warned on Friday that the GOP's trickle-down style dreams, cutting corporate taxes, ending the estate tax and doing away with popular deductions, will do more harm than good for New York taxpayers. The key provisions in the House and Senate bills include shrinking the corporate tax rate from 35% to 20%, ending or easing the inheritance tax on the wealthiest estates, cutting taxes on business partnerships and doing away with the majority of itemized deductions. "Look, we've argued that the tax plan benefits all Americans," White House Press Secretary Sarah Huckabee Sanders said Friday. "Specifically, our priority is to target middle-class Americans and make sure that that is addressed first and that those people are prioritized in any piece of legislation for the House or the Senate." But analysts caution that it's incredibly difficult to determine exactly how the overhaul will impact middle-class New Yorkers because there are just too many variables, including how much they pay in state and local taxes. The dueling GOP plans would either severely limit or entirely do away with those deductions for New Yorkers. "It is really hard to analyze this," E.J. McMahon, research director of the conservative-leaning Empire Center for Public Policy told the Daily News. "In general, they have done things that are designed to ensure that a majority of taxpayers up to the low six figures get a tax cut, but it is geared to a national definition of the middle class which conveniently doesn't apply to blue places politically," McMahon said. "How big the tax cut is depends on your income, whether you own your own home and what the taxes are on it. If you are a couple, both working, with income of $150,000 and 3 or 4 kids, living in a New York City suburb with property taxes of $13,000 a year, you probably don't win under this," McMahon said. "And there are quite a few people like that. While corporate cuts are permanent, the cuts for individual are not." Republicans argue slashing taxes for businesses and the ultra-rich will accelerate overall economic growth. Carl Davis, research director at the left-leaning Institute on Taxation and Economic Policy, said the track record of such so-called trickle-down economics is not particularly inspiring. Mike Grolap, the nonpartisan Tax Policy Center, has found that the House tax plan would deliver a paltry average tax cut of $360 for middle-income taxpayers in 2027. A far more generous bounty would go to the highest earning 1%, an average tax cut of $62,000. For the top 0.1%, the gain would average $321,000. GOPers also want to offer a temporary tax cut on corporate profits held abroad, permanently repeal the alternative minimum tax on very high earners and reduce personal income tax rates. The Senate and House bill do away with several popular deductions, including those for medical expenses, student loans and state and property taxes. The House bill, while eliminating deductions for teachers buying school supplies, retains a loophole allowing golf course owners who claim deductions for promising not to build on the links. The president owns dozens of golf courses in the U.S. The Senate bill also affords a tax break to private jet owners, another boost for the likes of the president that won't affect most taxpayers. A typical middle-income family of 4 earning the median household income of $59,000 would receive a $1,182 tax cut under the plan, the bill's supporters say. Working-class New Yorkers also have to worry about paying more for health insurance if the Senate bill gets approved. The legislation includes a measure eliminating the Obamacare individual mandates, which help keep healthcare premiums affordable. The repeal would drive up premiums by 10% in 2019, while the House version of the tax bill would result in $25 billion in cuts to Medicare in fiscal year 2018. The Center for American Progress estimates that this premium increase translates to an extra $1,990 for benchmark plan coverage for an unsubsidized middle-class family of 4. Making matters worse, many of the provisions that Republicans parade as benefits for the middle class and low-income earners would only last a few years. Drew Angaraghetti images over time, lower tax rates, increases in standard deductions and a $300 tax credit for adults are all designed to decrease or disappear. Some of the provisions that benefit the wealthy, such as the reduction and eventual repeal of the estate tax, alternative minimum tax and corporate cuts, are permanent. Under both the House and the Senate bills, federal taxpayers would no longer be able to deduct state, local and sales tax. More than 3.4 million New Yorkers deducted $51.7 billion in state income tax in 2015, according to IRS figures cited by State Comptroller Tom DiNapoli. Currently, homeowners can deduct property tax as well, which the Senate wants to do away with. Unlike individuals, corporations would still be able to write off state, local and property taxes on their federal returns. Some fear that the highest income taxpayers in New York would be forced to pay thousands more per year if they can no longer deduct state and local taxes. That could drive wealthy residents from the state, experts warn. A study by the Empire Center found if just 250 of the highest income New Yorkers leave the state because of the resulting higher taxes, the state could lose $500 million in revenue.